Business Finance, BA 334, Chapter 2. In Chapter 2, we start looking at the financial statements for a company and talking about the different information that as financial analysts we get from those sheets. So the first is the balance sheet. Remember, this is a snapshot of assets and liabilities at any given point in time. So the balance sheet is usually a very specific date, and it's the information from that date. We know that the balance sheet equation for accounting is that assets equal liabilities plus stockholders' equity. Assets can be situated on the left-hand side of a side-by-side balance sheet or in the upper portion of a vertical balance sheet. Assets are listed in the order of decreasing liquidity, with the most liquid assets or the most current assets on top and followed by fixed assets or long-term assets. Then we have liabilities and owner's equity. Owner's equity section can also be called stockholders' equity or shareholders' equity. This is on the right-hand side in a side-by-side or underneath the assets in a vertical balance sheet. It is in ascending order of when items are due to be paid for the liabilities. We can see an example of a balance sheet here that we have the total value of assets, which is a mix of current assets and fixed assets or long-term assets, and the total value of liabilities and shareholders' equity. So current assets and current liabilities are those items that will either be turned into cash within the next year or operating cycle. For current assets and for current liabilities, those items which will be paid within the next year or operating cycle. Long-term debt for liabilities are those items that are due more than a year from now, and our shareholders' equity combines our owner contributions, any additional paid in capital, and our retained earnings. The fixed asset portion contains our long-term assets. Those long-term assets can either be tangible or intangible. Examples of tangible assets are buildings, property, equipment, and example of intangible assets are trademarks, copyrights, goodwill, patents. When we do financial analysis of our balance sheet, some things that we're looking at are the net working capital. Net working capital is current assets minus current liabilities. We want this number to be positive, to see a healthy firm, meaning that we want to have more assets on hand to make sure that we can cover any liabilities that are coming up for the next year. The liquidity of our assets. So this is the speed and ease of conversion to cash without significant loss of value. We know that everything that a company owns or every asset that we have can be converted to cash at some point in time. However, in order to increase the speed which those are converted to cash, we might have to very much decrease the amount of cash that we are receiving for them in relation to their value. So the faster that we can turn them over into cash without significantly decreasing that value. Our liquidity is valuable in avoiding financial distress, bankruptcy, in recording our ability to meet our financial obligations for the future. And then we're also going to look at debt versus equity. So what is our shareholders' equity versus our liability components in relation to our assets? So again, where we have assets equals liabilities plus shareholders' equity, then our shareholders' equity equals assets minus liabilities. This is an example of a balance sheet for a generic corporation the textbook has created to look at the analysis of various things within this chapter and future chapters. So we have U.S. corporation, we have information for 2 years. This is a side-by-side balance sheet where assets are shown first and then liability and owner's equity are on the side. Other financial things that we're going to discuss are the market value versus the book value. We know that the book value, or the accounting value, the balance sheet value of assets, liabilities, and equity, is historic information. That is recorded under US GAAP, that we record information at its historic cost. The historic cost does not always indicate what the market value is. They're often very different. The market value is the true value of a corporation, or the price at which the assets, liabilities, or equity can actually be bought or sold within the marketplace. Why are they so different? Well, corporations that have existed for very long times might have purchased some of their assets, such as property, a very, very long time ago. For example, it could have been 50 to 100 years when they purchased some of their property. Because of accounting rules, we have to record things on our balance sheet at historic cost, which means the cost that we paid for them at the time. The market value of a property that was purchased 100 years ago can be significantly different than what the historical cost of the property was that is carried on the books. Now, which of these is more important to the decision-making process? Well, often market value is what we're going to be looking at. This is an example of market value versus book values. So we have book value of $700 for our fixed or long-term assets and an appraised market value of those assets of $1,000. Current assets are $400, but approximately $600 would be realized if they were liquidated. We have $500 in long-term debt, both book value and market value, and no current liabilities of any kind. So what is the book value of the equity and what is the market value? If we make two simplified balance sheets, one in accounting or book value and one in economic or market value terms, we can see that the market value is 500 greater than the current book value. So shareholders' equity is worth twice as much as what it is shown on the books. The distinction between book and market values is important because book value can be so different from our true economic or market values. The income statement is performance over a specified period of time. It can be a period, a quarter, a year, a month. We report our revenues first and then deduct any expenses from the period. The end result is the net income. That's our bottom line. Then we have after dividends paid to shareholders, any net income remaining is an addition to retained earnings. The income statement equation, the base equation, is net income equals revenue minus expenses. On the next slide, we'll see an example of an income statement for our fake corporation from our textbook. So we have our sales, then our expenses, our earnings before interest and taxes, or EBIT, interest, taxable income taxes, and our net income. Then we're given our dividends. Net income minus dividends is our addition to retained earnings within the equity section on our balance sheet. As of 2017, corporate tax rates are a flat 21%. Tax rates are, of course, subject to change as Congress changes tax rates. Financial statements have to follow GAAP rules. Some of these rules you've encountered in other classes. One of these is the matching principle. This requires that revenue is recognized when it is earned, and we must match expenses required to generate revenue to the period of recognition. It does not mean that revenue is recognized when we receive cash for it. So cash flows are very different from information shown within financial statements. We also have non-cash items within financial statements. The biggest non-cash item within an income statement is depreciation. These are expenses charged against revenue that do not affect cash flow. Our biggest non-cash expense is depreciation. We also have the timing and costs of information on our financial statements. So are costs fixed or variable? This is not always obvious on our income statement. Given a long amount of time, almost any cost can become variable costs. However, we look more at whether costs are period costs or product costs when we are creating income statements following GAAP rules. So we can have variable and fixed costs within each one of those components. Other things might be earnings management. Earnings management occurs when a company tries to smooth their earnings. GAAP does leave wiggle room for earnings, but we want to discourage corporations from really doing so. It's a controversial practice, and it can move into an illegal practice if we take the wiggle room that is allowed so far. So we might take steps to overstate or understate earnings at various times to help smooth out any dips or surges we have in our revenues and expenses in order to make things look more steady and stable. We also have the global standardization of accounting, or GAAP, versus IFRS. So GAAP are the US generally accepted accounting principles, and IFRS are the international financial reporting standards. There are areas in which GAAP and IFRS agree on the treatment of accounting things, and then there are several areas where they don't agree. In international companies, you have to, they often have to convert for whichever country they are reporting in, and within their annual statement, notes to their financial statements, they would talk about how they convert from those GAAP to IFRS rules. There has been a long, more than 30-year process where they have been trying to make those standards more and more similar, but there are just a few things in which they are very different on that they have not been able to come to agreement on. We also have taxes. When we look at taxes, we look at the marginal versus the average tax rate. So our marginal tax rate is the percent of tax paid on the next dollar earned. Our average tax rate is the total amount of taxes paid divided by our taxable income. If we were considering a project that would increase our taxable income, which tax rate would we use in our analysis? In your textbook, there is a marginal tax rate chart on page 31 for the current personal tax rates that were passed at the end of 2017. And that taxable income, we're going to do some examples in class on how to determine what your taxable income is based on those personal tax rates. Corporate tax rates. Following the passage of the Tax Cuts and Jobs Act in 2017, the federal corporate tax rate in the United States became a flat 21% of corporations. So for the time being, we have a 21% flat tax rate for corporations. This, of course, is subject to change if at any time we pass a new tax bill that would require the change of tax rate.